Now, as we turn to Europe, things have bounced a bit, and not in a way where it's like, oh, things are getting so much better. It's just, you can only be so bearish. You can only see the data go down so much because a lot of this is continuous. So as things have continued to get worse, well, at some point they just stop getting worse and just kind of hang out here. And that's what we've started to see. And that's, I think, an important piece that we want to look at in general. So now looking at the Eurozone in general, economic confidence held in right at the level of 93.7. Industrial confidence got worse, but that was expected because that held up longer than it should have. And it was supposed to come in at negative 0.5, came in at negative 2. That's a bit of a makeup. Where service confidence, again, fairly flat, right where it is. That should start to roll a bit, especially as consumer confidence remains fairly negative. CPI estimates were expected to be at 10.4, came in at 10%. And if you look at just the sheer rate of change and moves, to see this kind of pause here for a minute is not crazy because you did get a lot of warmth in November that helped bring down natural gas prices, that helped bring down electricity prices, and some of that has reversed in December. So it's going to be a mixture of things going forward. But again, just as we've been saying, it's just more of pivoting from inflation into stagflation. Eurozone manufacturing still in contraction at 47.1, right in line with estimates. PPI got a bit better. Again, speaking back to diesel and natural gas and electricity, it was expected to be at a decline of 2%, came in at negative 2.9%. Year on year, it's still up 30.8%. Services PMI expected to be at 48.6, came in at 48.5. Eurozone composite right around 47.8. So investor confidence got a bit better versus estimates, was expected to be at negative 27.5, came in at negative 21, with retail sales kind of right in line. So not, again, just fairly negative, all showing contraction. It's just a question of when do we get a bit more of a pivot, and that's we think it's more of when the U.S. starts to roll harder. You'll see that second leg down on some of the economic indicators, just given where some of that trade sits. So when you look at with China, when you look at China in general, exports to China remaining elevated in general, exports to emerging markets excluding China, you can see that disconnect. So as China has slowed and we've seen their imports come in negative, well, that's a problem. So even as you get a reopening in China, and we'll talk about that more in segment 5, you're not going to see a huge pickup in production. You're not going to see a huge pickup in inventories just because there's so much inventory. You're not going to get to see a big pickup in imports, which is going to be a problem for Europe. Euro area profit margins, China average of headline CPI and PPI. You're looking at some of the different pieces where profit margins are going to continue to roll and put more pressure on European companies. Eurozone composite, giving you an idea of it went down. Survey was 47, came in at 47.8. But again, it's important to look at where we are in that cycle, and so you get a bit of a bounce. Do we get a trend change? No. Can we just kind of hang out at 47? Sure. It's still contracting. It's still, could it get a bit worse to 45, then up to 48? Yes, but the problem is, it's a matter of it's just how bad is it? Is it really bad? Is it somewhat bad? But it's a continuous look. So you're seeing things continuously contract. All the while, input prices on the composite side came in at 71.6, which is a down move, but still expanding. It's just the rate of change has slowed. But again, that is going to put more pressure on companies, more pressure on the economy, because margins, investments, all of that is showing more downside. Economic confidence hanging right around here, again, a bit of a pause. Output prices came down a bit to 62.8, but still near the highs. Again, leading to more of a stagflationary conversation versus anything else. But with the difference at this point is the U.S. is moving into stagflation, but still has some areas of growth, where Europe is moving into stagflation with no real areas of growth and more contraction, which is why we see Europe entering into a deeper recession than what the US is going to be in. And both of them are going to last longer than what I think expectations are. Manufacturing confidence expected to be at negative 0.5, came at negative 2. Eurozone service confidence, again, moving in the wrong direction, hanging in, but you can see just where it normally is and where it is right now, because it looks like, oh, well, 2.3 is still expanding, but it's usually much higher because services is such a big component of the European markets and the global and the European economy. Eurozone loans to household dipped, Eurozone loans to businesses flatlined, and that's something that we see going lower, especially as rates go up, margins come down, and spending slows further, and that's again going to have that ripple effect and create more problems on the economic side. And then this just puts into kind of an idea of where inflation is, but core inflation didn't move. So you saw the headline number come down, but as we said in the US and elsewhere, Europe is no different. The Eurozone core CPI is going to be sticky. It's going to be a problem, and we do not see that changing in the near term. Eurozone PPI came down, but you can just get an idea going back to 2005. Even as it comes down, you're still at a very high level. Now looking at Germany, CPI expected to be at negative 0.2, came at negative 0.5. Unemployment pretty much a little bit higher than expected. Retail sales, steep move down, was expected to be at negative 0.5, came in at negative 2.8. German manufacturing expected at 46.7, came in at 46.2. Import prices dipped lower. But then when you look at exports and imports, so when you look at imports, they were expected to be down 0.5. Instead, they were down 3.7%. That is a huge problem when you look at a country that is an exporting nation. They export a ton. So that is telling you not only are we seeing less exports expected, but it's also going to show that local demand is diminishing. And then exports were supposed to be down negative 0.2. We're down negative 0.6. Remember, imports are a leading indicator, and there is a big problem right there. Service PMI was expected to be at 46.4, came in at 46.1, putting the composite right near in line at 46.3, with factory orders slightly better than expected, but construction worsening, the PMI for construction worsening to 41.5. So Germany is still getting slightly worse, and Germany being the largest piece to the European economic footprint is a huge problem when you consider where they are, where they're going, and why we're so concerned about Europe versus other areas, because their growth engine is sputtering and at a worsening rate with additional problems, and those import-export numbers are showing that in even further. PPI month over month gives you an idea of some of those shifts, but European industrial companies are reporting a deterioration in their competitiveness in the global markets. That is not something that is going to change, because Europe, the ECB, is still well behind raising rates. So rates are still going to go up. But as rates go up, you still have high costs. You still have all of these other problems. So as rates go up, your cost of capital, or your weighted average cost of capital, your WACC, is going to move up. Your cost of debt's going to go up. What you have to pay to employees is going to remain elevated. And again, that's going to hurt the competitiveness that you have into the market. And it's important because Europe, especially Germany, is so reliant on the export world. Good. Looking at the IFO data sets, you can see the business expectations improved. But as you can see, it's still, the assessment of the business situation continues to deteriorate. So you're getting some of the business climate getting a bit, it's not getting as bad. It's all still negative. But then when you look at the business situation, it's all continuing to deteriorate on the manufacturing side, service sector side. Trade, a bit of a flat line, just kind of bumping around zero, with construction, again, as we showed earlier, continuing to be a massive overhang. Now, when you look at retail sales, here's a big pivot lower. But when you look at the German pensioner, and again, when you look at it in general, the value of pension funds, the 10-year constant duration bonds, after 3% distribution each year, real return in local currency, you're seeing a huge drop. And it just means that this chart, is a long way of showing that Germany has a very underfunded pension. And it's an underfunded pension by a huge margin. It's something that it's actually worse than when Germany reunified, and essentially when the Berlin Wall fell, the ratio of value of pension funds to German real GDP is the worst now than it was then. And I think that is a huge problem when you look at, well, all Germany and German pensioners have been financing Greece and Italy and by way of the ECB in terms of borrowing, retirement ages, and how much longer will they handle that or accept that before we see some bigger issue within the EU. German manufacturing PMI, again, was expected to be at 45, came in at 46.7. A little bit of a bounce. New orders bounced, but it's still at 39.1. So it's still contracting, just at a slower rate, which is still a problem when you look at underlying growth. So then when you look at France, France CPI came in slightly higher than expected. But remember, last month they were slightly lower than expected. So just kind of splitting the difference here, PPI still remaining elevated, coming down. Consumer spending falling in line with where we've seen others fall. GDP right there. Manufacturing PMI getting slightly worse, expected to be at 49.1, came in at 48.3. Industrial production, all of that moving negative at a faster clip. French PMI services were expected to be at 49.4, came in at 49.3. So composite right at 48.7. So again, not much worse, except for the manufacturing side. The manufacturing side is the concern that we have on a global basis, and Europe is no different. French business confidence indicator was expected to be at 101, came in at 102. Again, production expectations getting weaker as we continue to see a depressed move on the manufacturing side. Industrial production falling out of what has been normal. Manufacturing so came in at 96.3. Production came in at 99, all of which are moving in the wrong direction, and we do see that accelerating to the downside. PMI, nice bounce, but again, new orders bounced, but still deeply negative and deeply in contraction. The leading indicators showing that things got worse, just not were worse, just not as bad as previously before. Service PMI expected to be at 50.6, came in at 49.4. Service PMI for Germany, again, you're seeing all of this now move negative. And France is 49.4, 50.6. You're kind of like slight growth, slight contraction. It's just showing you that kind of that pause that we're seeing on that underlying level of growth. So now when we look at Italy, industrial sales, all of that dropped off. PPI dropped off hard, which is nice, but again, should have been expected just given the level that it was at previously at 53. GDP, fairly in line. CPI actually beat estimates, expected to be at 12.1, came in at 12.5. Month over month, same thing, moving to the higher. But manufacturing did pick up. It was expected to be at 47, came in at 48.4. But service PMI expected to be at 47.5, came in at 49.5. Italy composite was expected to be at 46.5, came in at 48.9. Still contracting, but not contracting as bad. But we do see Italy getting worse. And here are some good charts that show that. Holiday spending in the ECB is expected to roll over, but the real income squeeze is massively accelerating in Italy. And that is the biggest concern we have heading into 2023, where Italy we think is going to get much worse, much quicker because of some of these underlying shifts, especially as we've already seen in the leading indicators going into November and December. Germany, as you can see here, remaining elevated. Spain, something very similar. Survey at 7.1, came in at 6.6. So things are still bad, but it's just not as bad as the worst point. But we don't see much improvement from now till the end of the year, and especially as we go into next year, as the global economy slows, and that's going to weigh on exports even further. So that's what we have for you on the European side. In the next segment, we're going to go deeper into Asia, and that's going to kick off with China.